myself, like most others, had been influenced by the prevailing economic policy from the 80s, the 90s, until the beginning of the 21st century, that the growth of the financial markets was the main pillar of economic prosperity in modern times. And if you allowed the financial market and the banks and the financial institutions to grow, somehow it will bring prosperity to all. I was not aware, and we were not aware until the banks collapsed in my country, and we saw what happened afterwards, that the Icelandic banks, like the British banks, the European banks, the American banks, had in fact become high-tech companies, hiring engineers, computer scientists, mathematicians, IT specialists, people who normally would have gone into the innovative, competitive sectors of the 21st century economy. But the banks had been offering them higher salaries, offering them big bonuses, and therefore high-tech companies, IT companies, industrial companies that had a great market potential were not able to realize it because they couldn't get the people from the engineering departments, from the mathematics department, and so on. But when the banks collapsed, this pool of talent was suddenly available. And within 6 months, they had all been hired by a combination of all kinds of high-tech companies, IT companies, innovative companies. So in the last 3 or 4 years, almost all of these companies have been extraordinarily successful. And their success is one of the reasons why the Icelandic economy has recovered earlier than any other European economy that suffered from a financial crisis. So that has led me to conclude, and I'm prepared to argue that case at great length, and I think it's an important message to a modern business school, that if you want your country or your economy to be competitive in the 21st century global economy of innovation, of IT and high tech, a big financial sector, even a very successful financial sector, is fundamentally bad news for your economy.